Investment Attraction Fund Management and Utilization Strategy. Congratulations! If you have successfully attracted investment, now is truly the crucial beginning. The future of your company can greatly change, depending on how you manage and utilize the funds received. It's not enough to simply feel relieved that money has come in. You must approach it even more strategically and carefully. 1. Immediate actions after investment attraction. The first thing you must do immediately after receiving investment is to transparently complete all legal and accounting procedures. Execution of legal procedures. You must carefully check and fulfill the conditions specified in the investment agreement. In particular, the process of receiving investment funds and issuing new shares through a paid-in capital increase procedure must be handled accurately with the help of legal experts. You must not overlook administrative aspects, such as shareholder register organization and board resolutions during this process. Clarification of accounting treatment. Investment funds are injected as company capital, so they must be accurately recorded and managed in the accounting books. Maintaining a separate dedicated account for investment funds also helps ensure transparent management. Establishment of communication channel with investors. Even after attracting investment, regular communication with investors is very important. You must maintain trust by transparently sharing fund utilization plans, progress, and performance. 2. Core principles of fund management. You must have the understanding that the received funds are not simply your money, but seed capital for future growth. Transparency and accountability. All fund flows must be clearly recorded and managed. This is crucial not only for internal control, but also for building trust with investors for future additional investment attraction. Strategic allocation. Investment funds must be allocated to the most efficient areas for achieving the company's vision and goals. Beyond simply filling gaps, you must focus on core areas that can accelerate growth. Efficiency and prudence. Unnecessary expenditures must be minimized, and funds must be utilized as efficiently as possible. It is strictly forbidden to overspend just because you have money. Risk management and contingency planning. It is wise to secure a certain portion as contingency funds to prepare for unexpected situations. You must create room to flexibly respond to market changes or unforeseen challenges. 3. Key areas for strategic fund utilization. Investment funds are like fuel for a company's growth. Where and how you use them determines the company's speed and direction. Product service development and enhancement. R&D. This is the most important area for strengthening a company's core competitiveness. You must focus investment on technology development, new product launches, and improvement of existing products to secure market dominance. Market expansion and marketing. These funds are necessary for acquiring new customers and increasing brand awareness. They can be used for domestic and international market entry, execution of effective marketing campaigns, and expansion of sales personnel. Talent acquisition and retention. The most important driving force for company growth is ultimately people. You must invest in recruiting excellent talent, strengthening the capabilities of existing personnel, and establishing compensation systems for motivation. Operating infrastructure establishment and expansion. As the business scales, you must invest in necessary systems, facilities, and office space expansion to establish an efficient operating base. Working capital funds needed for daily operations, such as labor costs, rent, material costs, and other fixed expenditures. You must secure sufficient working capital to prevent liquidity crises. Contingency fund funds set aside for unexpected crises or opportunities. These play a crucial role in enhancing the company's stability. 4. Continuous monitoring and reporting. Continuous monitoring and reporting are essential to maximize the effectiveness of fund utilization and maintain trust with investors. Regular financial reporting. You must regularly report to investors on fund burn rate, key performance indicators (KPIs), and financial status. Transparent information sharing can also lead to additional support from investors. KPI tracking. You must consistently track through key performance indicators how much of the goals you aim to achieve through the investment funds are actually being realized. Open communication with investors. You must communicate honestly about not only good news, but also difficulties or unexpected problems, and jointly seek solutions. 5. Common mistakes to avoid. Excessive spending. Spending lavishly after attracting investment is the most dangerous mistake. It can lead to a rapid increase in the burn rate due to unnecessary increases in fixed costs. Unplanned fund execution. If funds are used without a clear plan Efficiency will decrease, and ultimately, you may fail to achieve your goals. Lack of transparency. Opaque management of fund usage details can break investor trust, which can have a fatal impact on the company's reputation in the future. Ignoring investor expectations. Disregarding the performance or direction expected by investors and executing funds independently can lead to a deterioration of relations. Fund management and utilization after attracting investment is a very important process that determines a company's survival and growth. Please remember the principles and strategies discussed today, and manage your funds wisely to achieve great success for your company. Fighting.